Hi everyone, Mike here with Benchmark Financial. Today, I want to present you with some evidence which shows the impact of fees on your portfolio over time. Many of you invest because you are familiar with the magic of compound interest and how it impacts your portfolio over time. What you must also understand is there is an opposing force to compound interest. Offsetting the magic of compounding interest is the tyranny of compounding fees, and I'll show that in my data. John Bogle, founder of Vanguard and champion of low fees, famously quipped, "You get what you don't pay for," meaning the less you pay in fees, the more stays in your portfolio, and that savings compounds year after year after year. So let's jump in and take a look at the data. Here we have a chart showing the returns of a portfolio over time. This chart allows us to enter the portfolio and management costs, asset allocation, annual contributions, and annual returns of the broad equities and fixed income markets. We will set up the portfolio and, all things being equal, isolate the impact of fees on the portfolio over time. Let's start off and assume that we have a portfolio of a couple in their mid-50s with a starting balance of $1,250,000, and they make annual contributions of $20,000 a year. Now, let's assume this portfolio is made up of 70% stocks and 30% bonds. That is our desired asset allocation. Now, historically, we know that stocks have earned about 9.6% per year, and bonds have earned about 4.5% per year. Now let's look at the important part, fees. Let's assume you have went through your statement and found the following information. You see in your monthly statement, there's a line item called management fees, and it has a dollar amount of $1,822.92. Well, doing a little bit of reverse arithmetic, we can see that this is a yearly fee of 1.75% of the portfolio. Let's do a little more research and find that the average expense ratio of the investments in your portfolio is 1.02%. Summing this together, we can see that our combined fees are equal to 2.77% annually. So this is what we'll use to start with. So here is where we can see the tyranny of compounding fees. This couple, 55 years old, can reasonably expect to live another 25 years. That would put them at about 80 years old. Looking out 25 years, we can see that the returns on the portfolio are a little over $8 million. That is the sum of both parts of the column. Of that $8 million in returns at 2.77% in fees, you get to keep $3.79 million, and your financial advisor gets $4.63 million. And don't forget, he or she probably has 30 or 40 more clients just like you. At Benchmark Financial, we think this is unfair. Our fee for a $1.25 million portfolio would be about 0.77% management fee, and add to that about a 0.08% in expense ratio fees for a combined total of 0.85% total portfolio cost. As we slide the fee cost down, you can see the picture is much different than the high fee option. The same couple with the same portfolio earning the same returns is now keeping almost twice as much as they were with the high fee financial advisor. All right, I know what you're thinking. Not everyone has a $1.25 million portfolio, right? So what does it look like if I'm a 30-year-old with $50,000 in my portfolio and I'm making a more modest annual contribution? Well, let's look at that. I'll drop the initial portfolio down to $50,000. As a 30-year-old, you can reasonably expect to live another 50 years, so let's focus on the effect at the 50-year mark. At the 50-year mark, with the high-fee portfolio, the financial advisor and investment company have kept $5.3 million in returns, and you have kept $2.4 million. 2/3 of the returns on your portfolio over that time span are given away in fees. Folks, this is serious money. Finally, let's look at the low fee option for this scenario. In this scenario, our management fee would be 0.85%, and we will stick with the same expense ratio of 0.08% for a total portfolio cost of 0.93%. In this scenario, you are keeping $5.2 million in returns, and the advisor only gets $2.4 million over the course of 50 years. This is a much better scenario, as you have more than doubled the amount of returns you get to keep. This is money in your pocket, not someone else's. I hope that the illustration today has been able to help you understand the impact of fees on the portfolio over time. Folks, it is so important for you to understand certain things about your investments, and one of those things which you absolutely must understand is the fees you are paying. You would not walk onto a car lot and buy a car without knowing how much you are paying for it. The same goes for your investments, which are much more important than a car. At Benchmark Financial, we believe in keeping costs low in your portfolio. When building your portfolio, we understand the broad market is largely out of our control, as we individually just do not have enough money to control what the market does. Knowing this and accepting this, we focus on the aspects of your portfolio which we can control. And one of those aspects is costs and fees and what we pay on our portfolios. If you would like us to help you identify what you are paying in fees in your portfolio, we would be happy to do that. Just give us a call at 319-220-0401 and schedule an appointment. We will provide you with a free, no obligation cost analysis on your current portfolio and show you how we can save you on fees. Thanks and have a great day.